How's it going, everyone? I wanted to spend a few minutes today to talk about my portfolio's worst stretch, the period of time where my portfolio was doing as bad as it's ever done. I want to talk about what happened and what I learned, and maybe what you could learn from my mistakes. I think it's important to recognize that terrible results don't always happen in a vacuum. There's good times that lead to bad times, there's bad times that lead to good times. And the point being, there's always something that happens before, a framework, an approach that leads you to doing, or led me to doing, too much of one thing, and that kind of leads to problems. So what I'm going to do today is I'm going to jump into the returns in an account that was opened in late June 2020, and this was a concentrated account. It's less concentrated now, but it was at the time a something like 5 to 8 stock account. It was very concentrated, had what I thought were my best ideas in there, and there was some turnover. I don't turn over my portfolio as much as some others, but there was some turnover. I'm going to show you the returns that happened versus different accounts. I'm going to show you the drawdown. I mean, you'll see it in a few seconds. And I'm going to talk you through where my headspace was going kind of in slow motion along the way. So this account in the fourth column on the right was started basically at a time where the market was rewarding any risk. The more risk, the better. The stupider, the better. And the returns that it started off with were above the market because there was more risk in the account. And it's easy, well, it was easy for me to look at the account, look at, some of the more ridiculous stuff that was going on in the market and be thinking, okay, the market is rewarding risk. I'm doing okay here. There's probably some stuff that I'm doing that's probably too risky. And that was into the middle of 2022, really. And then the market kind of fell off and some of the stupid stuff just really fell apart. And I didn't, I had pivoted a little bit before that, but I didn't really fall off with it. And then that's where the problem really began. Because in late Q4 and early Q1 of heading into 2022, the market wasn't doing particularly well. And that's where I got some luck out of left field. And, dodging the downside of the market and plus having that luck, it got into my head as, well, maybe there's some value add, maybe there's some thing that I'm doing right that the market isn't. So maybe there's some alpha here. And that's really that thinking, what in reality was pure randomness and luck, thinking that might be, okay, maybe something right that I'm doing. That was kind of the beginning of the end. And after Q1 of 2022, things started going poorly and quite poorly. Now, what was maybe alpha very quickly turned into no. Obviously in Q2, it's like, okay, nothing works well forever. It's still an okay year, but there's still some, problem here, but things can turn around. And then they started not turning around and getting worse. And I think there's a very important point that needs to be said here. And if you've experienced it, you know what I'm talking about. And it's that volatility messes your headspace up pretty badly. And when things are going volatile on the upside, you get this view of the world that is that you're kind of detached from it in one way, and when things are volatile on the downside, you get detached from it in another way. And neither of it is particularly healthy, but both of it happened. And when when you're detached on the positive side and then things start going poorly, you don't necessarily grasp what's happening. So Q2 of 2022 was minus 14.5%. Q3 was minus 23.4%. Q4, maybe the beginning of something new, positive a little percent. And I'll show you after, there was a lot of bumping around in here. It wasn't as simple as a little bit bad, worse, whatever. But then no. Then it got worse. Then it was Q1 of the next year, minus 18.4%. Then Q3 minus another 9%, and then, you know, so any hope of maybe there's some alpha involved here, no, very, very much not at all. And then Q3 minus 29%, that was absurdly bad. I mean, the market was down, but you're down 10 times what the market's down. That's very, very bad. And that's when you're in a very negative space, headspace, and yeah. So I mean, by the end of Q1, that had erased the good quarter at the beginning of 2022, and then yeah. So then it kind of got to a point in Q3 or Q4. So this is more than a year of down, 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 big down. It finally got to the point where I kind of had to have a look at the portfolio and say, okay, where should the portfolio be going in the future? And what was I doing wrong? What was I bad at? What was I good at? And what did I need to have things look like going forward? And then, so let me get to more about that. But first I want to say I would not recommend a drawdown of that size. It is not fun. It does not feel particularly good. It is not good for your headspace or your belief in, you know, it erases a lot of positivity about investing, about markets, and about what you're trying to achieve. So obviously it's not fun, but you know, it's a reflection of some mistakes and some taking of too much risk, and the summation of it is, on a quarterly basis, like using quarter end numbers, a 65% drawdown. And realistically, it's probably a 70+% drawdown when you look at the intraday peaks to the intraday troughs. And that's not very fun. And that's a lot of damage that takes a lot of time to recover from financially. And realistically, here we are years later, and last year was a decent year, and the portfolio is still down 35%-ish from the peak, and it's going to take longer to recover. And I said before, the quarterly results don't tell the whole story. This is this is in slightly more detail what the results look like. And every bounce is hope that, you know, this was an unjustified sell-off, and, you know, or a justified sell-off because of some one-off thing that was going to be fixed, you know, a temporary issue going forward. And it wears you out. Every piece of potential optimism that fades away, be like, okay, this is it, we're done, we can start the real recovery now, and it just grinds you down. And the reality is, overall, Depending on where you start, depending on where you measure from, like the blue is obviously the portfolio returns, the red and yellow and green are the three benchmarks. So depending on where you measure from, it wasn't that bad, but it was also terrible, very, very bad, and very, very big mistakes were made. But everyone always wants the performance to be a straight line. Heck, I want it to be a straight line. It would be very nice. And if you look at the straight line, you could say, okay, that's what effectively happened. But you know, it's also not. And there's lessons from these very big mistakes. Now, as I said, this account was very concentrated. And for those of you that are wondering, well, what happened with the whole thing? There was a few things. There was multiple stocks involved, but the big one is, I mean, many of you who have followed for a while probably know of it. We'll call it green stock here because for a while it was very green and it was green a lot. But the point is, everything lined up. You had some massive growth, you had passing an inflection point, you had pricing, massive demand, operating leverage, everything lined up to work together very, very quickly. And then one by one and issue by issue, the whole thing derailed. And basically I didn't manage the risk, because what everyone always says about making good money in the markets is you got to let your winners run. And this had started in this account as a pretty decently sized position, and it became an even bigger position. And the reality is there was still a tremendous amount of upside, even at upside potential, I should say, even at the peak, which obviously has not materialized yet, at least. I think it's also important to realize that even within one stock, and this wasn't a question of getting one stock wrong once. Even within one stock, it isn't one event that, I won't say kills you, but kills you. It's incrementally, first it was guidance wasn't what I was hoped for. And I still remember that day very clearly, getting frustrated with why is the guidance so much worse than what it seems like it should be. And then it's okay, but there's going to be some recovery. This is just 1 year, 1 quarter, one whatever. And then it's some operational issue. And then it's some sales issue, and then it's some macro issue, and then it's some operational issue, and it's just over and over and over, and it just wears you out. And by the time you realize that the issue from 3 months ago was bigger than it seemed like at the time, it's on to the next issue. And that leads to the next one, and the next one, and the next one. So even within one stock, which, by the way, this was multiple things, was everything going wrong for a while, even within one stock, it's not one thing, not one event. I mean, it can be, I guess, if we're talking about a biotech thing, but it wasn't. It was a series of events. Now, I'm sure there's some people out there that are asking a very simple, or trying to make a very simple point around here, is why not just sell? Why not just, cut your losses, or say, okay, this isn't going well, just dump it? And on one hand, that's a very valid question. On the other hand, I think that there's really two types of people. There's types of people who flip easily in and out of stocks and just do it and are good at that. And then there's other people that are not good at that, that are good at holding a story for perhaps long enough and perhaps too long when it does not turn. And I think I am more the person who holds on too long than the person who is more likely to flip in and out. But the other reality of answering the question of why not just dump it is I can tell you this about the same stock that was the bulk of the problem. One is that prior to that point, I had held it through 2 different 50% drawdowns, and both were tremendous buying opportunities. And looking back at the time, this looked basically exactly the same. There were some different dynamics, but you know, the first 50% drawdown in the stock, it's like, okay, this is just what happens with this type of company. Second, of course, like I just mentioned, being able to hold something that long that goes up as much as it did, it takes a particular skill, which that particular skill lends to the particular weakness of not knowing when to just cut. And, you know, so everyone has their strengths, everyone has their weaknesses. Some people are great traders. Some people are great at holding something only while it's, you know, on some technical run and then cutting and then just waiting. And that's not my particular set of actions or skills or whatever. And yeah, but everyone needs to kind of know themselves. And the other thing is, even at the peak, even at the absolute top second, I could have looked at the stock and said, well, you know, if they continue executing the way they have over the last number of years, this is still easily a 10 plus bagger from the highs. So, you know, it's not as simple as a mistake, just simply easy knowing when to just move on. The other thing is, and this is a very important one, particularly when you're there and when you're looking at the situation of, okay, you know, sure, there's been some luck involved in what's brought it to here, but the amount that needs to go wrong for something like what happened to happen was like almost impossible. Just in terms of, to understand this, you'd need to know all the details that I don't have time to go into today, but it was a dozen things that each without the prior one, it didn't have to go this way. There was random stuff that just caused problems. And so as much as there was good luck on the upside, there was also equally bad luck. And when you feel that much good luck, when you see it happen, you aren't in a position to really be thinking about the problems that could happen, the left field problems, oh, this screwed up here, which is going to cause something else to break, which is going to cause something else. You're not in a position to be thinking about that, particularly when you have a number of good quarters after the other. It kind of feels like, okay, this is my life now. Things are going well, so let me just kind of let them. And doesn't it really work that way? You're also, and I really can't stress this enough, the volatility of upside vol, downside vol, so when things are going up a lot, when things are going down a lot, it's exhausting. And I feel like if you have gone through this, you probably know what I'm talking about. But even especially in stocks where you know that they're going to go up, or when they go up so much, you know you have to babysit them. But it's exhausting. You're watching every day, and yeah, even if it's going great, you're drained. You're drained from the sensation. And I've never really been someone who's done drugs, but this is kind of how I imagine the whole that would be like, in terms of it just pushes you really to a high, and then on the downside it just like um, just drains you. And the whole thing overall, volatility overall, I find it just makes you numb to the world, and it makes you dumb because things are happening that don't seem, it just doesn't seem real. And so you're not, it rips the rationality out of you. You think, I mean, I'm not the smartest person out there. I am fairly grounded most of the time in terms of calm, and this just takes that and destroys it. And if I were to distill that down to a single number, a single cautionary event, I would say that if the account moves by more than 20% in a quarter, whether that be upside or downside, you're probably not in the best frame of mind. Maybe you're in a good frame of mind because it's 20% up, but you're probably not in a good frame of mind to be like, okay, I'm just going to take this whole bunch of profit and shove it at this other risk because that's probably going to work because I'm on hot streak. Versus on the downside, it's probably, probably feels worse than it is in terms of it's not necessarily hopeless. You're not going to zero. You're not, you might be a moron. I mean, I might be a moron, but like, you're not that much of a moron, probably. So yeah, just, I don't know, 20% quarter. It's a lot. And, normally a good year would be 20%. So it just in terms of a time to check yourself type of situation. The other thing I should say, and I know I've seen studies to this effect, but downside or losing money is at least twice as bad as making money is good. So that's something feels like that's something to consider. So, did I learn from all of this? Hopefully. What did I learn? Well, mostly a bunch of obvious things, but realizing or having them happen kind of ingrains the lesson in a different way from just saying, well, duh, obviously. First, I learned that crazy things happen. And that means both on the upside and the downside. And I mean, obviously, but you just never know when, I mean, look, we had a pandemic, we had wars, we had all sorts of crazy stuff. And you never know when something crazy is going to happen in either direction to a stock you own. I also learned that growth and operating leverage is the way to go on the upside. I mean, this pushed me a bit further away from the value stuff and looking for stuff that was perhaps deeply undervalued and more to stuff that would rapidly create value. That's more of on the positive side from the experience. Whereas I also learned that the negative side of operating leverage is drains the life right out of you. I learned what should be obvious and has always been known, but really, really a point to be taken away from absolutely everything, is that management guidance is useless. If management knew the future, they wouldn't be running some, micro cap. So management, that they think what's happened, they're going to happen. They're optimistic. They hope for something, but that means nothing. Absolutely nothing. I also learned that my cost isn't my risk. You get to a point sometimes where you're like, oh, well, my cost basis is, a tiny fraction of the price that it's trading at today. And, if I sold, there's some taxes. So, I'm just kind of locked into the stock, or just, maybe it's I paid so little for this, and so I have so much margin of error, and it doesn't necessarily work that way in reality, because you know um, your risk is your opportunity going forward, and not necessarily what you put in. I also learned that commodities suck. Um, Realistically, there's been endless examples of this, and you'd think, oh, maybe now they know that, um, it's not a really good business. They should, when they, get a win, they should take a win and not just like find a way to, um, you know, undo everything. And it's incredible, the amount of commodity businesses that basically have a like a super cycle. Not just the ones that 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 I own, but like they have a super cycle. They make so much money, and a few years later, they're back to where they were before the super cycle. And it's just like there needs to be better quality businesses, because I mean, it's very really depressing. Another key point that you kind of get to too late is that it doesn't have to be a single investment that's the answer to everything. Um, there'll be multiple winners, and there'll be, maybe you don't see it right now, but there's going to be a new stock that you'll find eventually that's, you know, also a fantastic idea. It might not work also, but it doesn't have to be one investment that goes from zero to hero. The next question is, look, obviously the most volatile part of the experience here was a matter of concentration. So should I concentrate going forward? Should I be more diversified? That's another valid question. And what I can say about concentration is it could work, but it also has its drawbacks. It's good for the upside, certainly, when you find something good, but it's bad for the downside when that doesn't work. Now, concentration is one flavor of risk. There's many other ways of implementing, taking risk. One of it is, you can have maybe a larger portion of your portfolio in something safer and be taking less risk than having a smaller portion of the portfolio in something insane. So it really matters, both the size of the position, the type of the position, and all sorts of things. So it's not, I still don't think it's a single answer. Now, as I said, in this portfolio, now it has, I think it's 18, maybe 19 positions, which is much more than the 5 or so that I had before. So I mean, I think both could work. I think the type of position obviously matters. Now, when I think back also, the problem wasn't a 10% position or a 20% position. The problem became more problematic, and again, there's multiple problems. There was other losers in there that were big positions, but the problem isn't a 10%. The problem is when the position gets to um, 30, 40 plus percent of the portfolio, because then you have a risk of a single position pulling the rug from your entire portfolio returns. So, I mean, it of course depends on the risk tolerance of the individual. I perhaps have a higher risk tolerance, but it still gets to a point where at a certain size, it stops being a portfolio and starts being a position. And that is a different dynamic from a portfolio. So that's what I can say. The other thing I could take away from the experience is that there are three main levers that at least affected me. And most of them have like different dynamics, but there's really only basically three things. One is a valuation re-rate, which happened bigly, and then undid bigly. The second is rapid growth. Rapid growth, accelerating growth is something that the market really loves to see. And, if you find something before the rapid growth and it's not pricing it in, that's when you really kind of get the extra torque out of position, because also that leads to the valuation re-rate. But even if it doesn't, rapid growth, rapid increase in value, over a few years, especially, that kind of like shocks you, like in terms of what it does for the math. And the third is extreme leverage. Now, I'm not talking about margin. There was no margin used in that whole drawdown. It was just commodity leverage, which is just a different type of leverage, because there's pricing leverage. So really, these three factors are both what leads to exceptional outperformance and exceptional underperformance, along with, of course, the concentration. So it's really just math and multiplying. You get a multiple of the impact because you have a higher position. Then you have a multiple of the growth because you get the valuation re-rate, and then you get a multiple of everything because there's the operating leverage. So it's just, it's not 2 plus 2 plus 2 plus 2. It's 2 times 2 times 2 times 2. And really later on in that sequence, you kind of get the bigger spread between what a normal growth rate would look like and what a lucky series of events would look like. Now, to add a little bit to the commodity side of the equation, commodities for sure amplified and distort the fundamentals of a business. So they are, for lack of a better terminology, chaotic leverage. Now, this can be good if you're at the bottom of the cycle and there's like 5x on the upside of the commodity price and a few percent on the downside, and you could look at it from a math perspective and be like, well, this is a pretty good opportunity. But the reality is, once you get to what people would look at as mid-cycle, it doesn't have to go to those insane prices on the upside. It could go back down to the low prices on the downside. And there's a lot of disadvantages to running a business where you don't know if you're going to make money next year. And that's the truth of all commodities. They don't know if they're going to make money next year. And this is problematic because you need to invest a lot of capital to make make money to grow the business. And the chaotic nature values the business at a discount. It makes it more risky, and it's just chaos and not helpful, not necessary for an investment portfolio longer term. Of course, I still have some commodity positions. I'm just saying, like, when you're looking for quality, durability of a business, this really is just it's just a mess. The whole sector, the whole investing outlook, it's just messy. So what were my takeaways from this experience, and how have I refined my approach going forward? Well, the main thing revolves around quality and risk. Quality of the investments, quality of management, quality of the business. That's a big thing, just in terms of trying to find something with durable growing earnings that you don't have to worry about exiting. You don't have to worry about is something going to happen in 6 months that's going to break the business. So that's one thing. The other thing is risk. Risk both at a position level. Is the position too big? Is the position too risky? Is there something that can break it? And risk at a portfolio level. If interest rates go up, what happens? If interest rates go down, what happens? If the market sucks for a while, what happens? If the market's great, what happens? So basically controlling the exposure of, what would do good in inflation, what would do good in deflation, what would do good if the market sucks. So have balance from that perspective, and have some natural hedges. Also, on the position sizing, I like to think of positions as big, the optimal position of being big enough to win, but not big enough to lose. And what that means for each position is different, but I still like having relevant positions that could move the portfolio. But obviously, there's a certain point where it's just not worth the risk anymore. Lastly, and this is a big one, look for positions that add value and not hopefully add price. So companies that will grow the intrinsic value, hopefully rapidly, hopefully a lot, and not things where I'm hoping that the price will go up even more than, I'm not hoping to find a stock that's worth $10 today for $3 if the stock's going to be worth $9 in a year. And that's hard because you never know what the future is, but I prefer to buy the stock closer to fair value that's going to add more value. Now, the other important thing to realize is that investing is different for each person. What fits my skill set isn't necessarily what fits other people's skill sets, and what I'm good at is different from what other people are good at, and same thing for the reverse. I'm personally okay with taking risk when it makes sense. I'm good at holding for longer periods of time. I'm terrible at selling. I like seeing value being added, and I'm big on the tangible value. What I mean by that is I'm not good at, oh, this is growing revenues a lot and will someday be profitable and very profitable. I'm good at, okay, this, very clearly earns this much, or should be earning this much normally, or is worth this much if it was liquidated, some type of tangible value, and growing that tangible value. And I do not like babysitting positions. Basically, back to the terrible at selling, just I don't like having to watch a position and is today the day to get out? No, next day is today the day to get out. Day after that, maybe today's it's not a very fun way to go about existing. The last thing I have to say today is I hope this helps, but I know it won't. And what I mean by that is after this happened, I saw, I recognize that the mental state that people are in through this is not something that someone could come from the outside and help you with. Maybe a year after this, I saw someone who was basically where I was when everything was going right, and taking a lot of risk and having things work out, and they were ecstatic about it. And so what I kind of mentioned to them is maybe they should take some risk off, take a breath, and think about it, because that's what I should have done. I was not thinking clearly. I needed to take a pause and to cool down. So of course they ignored me and laughed at me. Of course, I would have probably done the same. And not long after that, the same thing happened to them with their biggest position. And it's unfortunate. It sucks. I didn't know it was going to happen, but I also did, if you know what I mean. It always seems to go that way. And this is one thing that before this had happened, I told myself if I ever got a success of that magnitude, I wouldn't be going back down the other side. And then I did. And so that also cuts deep as a personal failure. But the point of this story is that, you know, when you're in certain scenarios, you're not going to be thinking rationally, and that's what happened. And it will happen again. It will happen to some of you, perhaps. And, you know, hopefully some of this will help you realize that either the mistake wasn't only yours, or maybe it wasn't a mistake, or maybe this will cause you to sell too soon. It probably will. I mean, but there's no way of not making any mistakes in this game, and that's what, you know, you come to realize. So thanks for watching. Have a great day.